we finished just on this slide. So coming back to the point number one, I just wanted to add that based on the International Accounting Standard, item 38, intangible assets make it clear that advertising and promotion costs can never be capitalized as an asset. So not too sure about the rules in the US GAAP, but based on the UK regulation, they can never be capitalized as an asset. So, and also when I was checking information for Apple, for example, which is American brand, they would not disclose their marketing expenditures, so the rules must be quite similar. Now, the second question you may ask is, would labor costs be actually included in marketing costs? We spoke about this a little bit, but let me just clarify. Typically, labor costs would not be included in marketing costs. Labor costs would typically be included under wages or salaries, along with other salary costs. This disclosure of total salary costs is required in the UK under the Companies Act. However, interestingly was that the BMW or so I was checking where they put sales as well, and I think somewhere they have included the labor costs too. So again, it doesn't matter really what each company is doing, but when you're trying to compare the different expenditures, you should really compare like by like those figures. Okay, so what are actually the challenges in measuring return on marketing? Why this job is so difficult to do? So the first one is separating the impact of multiple channels. Let's have a look here. A research done by Lead Generation 2013, they asked what are the greatest challenges in measuring return on marketing? And 57% stated separating the impact of multiple channels. So we now use too many marketing activities, more than 300 marketing activities perhaps to choose from. And a bank I worked for, I actually did marketing program optimization for them. And can you imagine, just in one given year, that particular bank used 69 different marketing activities to address their small and medium-sized customers. By marketing activities, I mean any instruments or activities that would touch kind of the customers. So there was business breakfast, lunch, dinner, gifts, emails, calling campaigns, visiting client in their office, and so forth and so forth. And that's how I've calculated 69. So when you think about those sort of numbers, how do you even think of separating the impact of each of them? Think about Coca-Cola. How many and what kind of activities are you exposed to? TV, product placement, radio, press, Coca-Cola track, YouTube, banners, sponsorship, and so on. Makes it really difficult. The second one was difficulties in defining marketing activities in quantitative manner. So, for example, how do you actually express them quantitatively? If you look into, say, you want to measure effectiveness of advertising on TV, so how do you actually going to express that? Are you going to look into the number of ads viewed by a person, or maybe number of seconds that a person viewed, or how many different campaigns they viewed in total, and so on. And this is what makes it so difficult. The third point is short-term and long-term effects. So measuring marketing is kind of an inexact science. So if you look into here, short-term and long-term impact. So there can be different options available. So in a circle, you have cost, and in a square, you have return. So the one option available is that you incurred the cost right now. So you paid for, say, advertising campaign on the TV, and you have an instant return. The second possible option is that you paid for the advertising campaign, say on the same TV, but return is kind of starting a little bit later. So there is no like immediate call to action or something. It starts a bit later and it can continue for a couple periods. The other option is might be that again you incur the cost at the same period, and return started a little bit later and went for longer than in the second option. To complicate things even more, the cost can be actually split into different categories. So if you look into the same advertising campaign, you might be advertising in spring, autumn, and winter, for example, and you might be getting returns in all those periods. Or you might have advertised in spring, autumn, and winter, and kind of the return doesn't kick in straight away, and you need to wait a little bit. And also one more scenario when, say, you don't kind of have results immediately, you have to wait a much longer. So what happens, history impacts marketing effectiveness, and expenditures tend to be accounted for annually, whereas the influence of those expenditures, as you can see, is cumulative. Thus, a change in sales volume in 1 year could be the residual echo from previous year's activity rather than current activity. And let's go back to the list. Number 4 was external environmental factors can greatly affect the revenue, and there are some difficulties in attributing it to marketing. So marketing operates within a volatile and uncontrollable external environment that includes its customers, competitors, legislators, and so on. Thus, measurable effects on company performance can be experienced that are not directly attributable to the marketing's own marketing activities. So sometimes you might be more lucky than other times, depending on different external factors, and simply you might get higher sales, but not because you've invested so much in marketing. The number 5 point is the threshold points, which is very interesting. Let me just demonstrate that. Yeah. So in this section, what you actually have, you can see satisfaction on your horizontal axis, and you can see loyalty on the vertical axis. So actually, a lot of research has begun to question the linear view of the customer. And so basically what we questioned is the linear view of the satisfaction and loyalty relationship. Yet there is an ongoing debate as to the nature of the relationship. So the loyalty curve is relatively flat after a first threshold, as you can see, just right here. It's relatively flat. It's kind of relatively flat after a first threshold of satisfaction is passed, and then it climbs rapidly after customer satisfaction has passed the second threshold. So why does it climb rapidly after the second threshold point? So in the extreme level of satisfaction, delighted customers tend to ignore competing brands in favor of one which has delighted them in the past. So it doesn't matter exactly what the curve looks like here, but the important thing is to know that it's not linear in any way and it changes all the time. So that's what adds complexity in trying to measure marketing performance. Number 6 was synergy in marketing tools. And synergy, it means like 1 + 1 = 3, and kind of there is no trick, it's true. So say if you just did TV advertising, you increased sales by say 1,000. If you did just telemarketing campaign where you would call customers, you would get 500 orders. But if you combine the two, TV and sales calls, so it's not 1,500 you would get, 1,000 from advertising on TV and 500 telemarketing, but say you would have 2,000 because it creates synergetic effect. One strengthens another. So when activities are used in tandem, they tend to create a much stronger impact. And that's effectively what we're trying to achieve. Number 7, poor management rather than poor marketing. So what does that mean? Marketers themselves may have limited skills, experience, knowledge, understanding, such that they only know half of what maybe they should about the concepts that they use. and that's what creates problem. Number 8, marketing versus what marketing department does. There is continuous corporate confusion between marketing, the total business process, and what the marketing department does. So agreeing exactly what to measure the effectiveness of is an essential starting point for an assessment process. And finally, marketers are overwhelmed with choice. So question here is, do you know how many different metrics are available out there? It's more than 250. In practice, the operational selection of metrics from this vast pool was more arbitrary than scientific and exhibited a clear preference for the subjective, I'm afraid. Okay, let's move on now. Here we have one more exercise for you to make sure that we really kind of understand how to measure return on marketing investment. I'm sorry. Okay, so let's do this exercise. A company called Great Chairs sells chairs online. Before the display ad campaign, the revenue was $100,000 in month. So before the display, with 20,000 gross profit. A company launched display ad campaign and the revenue grows to $125,000 in the given month with gross profit of $25,000. Campaign cost is $4,000. What is the return on marketing investment? So we really need to understand what was the uplift or what was the contribution made by marketing. So in this particular case, what you can see is that after a company launched the display ad campaign, the revenue grown by to $125,000, and before that it was 100. And the profit the profit was 25,000. With campaign, without campaign, it was 20. So if you do 25,000 minus 20,000, so you would get $5,000, which was the difference in the result. And if you deduct $4,000, what marketing investment was, you would get $1,000. So let's again open just Excel spreadsheet and do a quick calculation here. So if you do 21,000, so that was the gross profit after a company did the campaign, and we deduct what was before without marketing. So what we want to do, we want to extract the marketing contribution. So it added 25, but there was 20,000 before marketing. And now what we also want to do is we want to deduct the marketing costs, and the marketing costs were $4,000, right? So that's what we get, 1,000. And now this amount needs to be divided by 4,000 marketing costs. And it is 25. If you look at percentage, it will be 25%. So what it means, so $1 invested in marketing gave a return of 25%. So let me try and explain it slowly once again. So on the top, we can see that the revenue grown to 125,000 with gross profit of 25,000. So we're looking only to the gross profit, which was 25,000. And we want to minus 20,000 because this is what would have happened without marketing. So marketing's contribution is really only those $5,000. We then minus the marketing costs, which was 4,000, and we divide the whole figure by 4,000. So hopefully this is clear. And 25% is actually quite realistic figure and should be quite satisfactory. It shouldn't produce like unrealistic results such as thousands or millions. 25% sounds reasonable.